So good morning and welcome to the second day of the Gatekeepers of Governance. Welcome to our plenary session. Regulatory gaps and overlaps, do they exist? Gaps and overlaps have been witnessed in the regulatory space. Is more interregulatory coordination the need of the hour? May I first request Mr. Damodaran to welcome all our guests on stage. May we welcome them on stage with a round of applause, ladies and gentlemen. So our speakers for the day are Mr. Ajay Seth. He is the Chairman of Insurance Regulatory and Development Authority of India, IRDAI, since September 2025. He was appointed as Secretary Department of Economic Affairs in 2021 and was made Finance Secretary in March 2024. Over the years, he has worked in several domains of public finance, social sector, administration, urban transport, and infrastructure, dealing with matters concerning public expenditure, tax policy, and administration. Budgets, accounts, project appraisal, foreign investments, bilateral and multilateral financial cooperation, development financing, public-private partnerships, school education, health, urban transport, and infrastructure. Ladies and gentlemen, Mr. Seth. Our next speaker is Mr. J. Swaminathan. He is the Deputy Governor of Reserve Bank of India, RBI, since June 2023. As Deputy Governor, he looks after Consumer Education and Protection Department, Department of Supervision, Financial Inclusion, and Development Department, Inspection Department, Premise Department, and Raj Bhasha Department. And prior to that, he was the Managing Director, Corporate Banking and Subsidiaries of State Bank of India, SBI. In a career spanning over 34 years with SBI, he has held various assignments across corporate and international banking, retail and digital banking, finance and assurance functions, and he has also served as chair of the Advisory Group to Regulations Review Authority, RRA 2.0 of the RBI, during 2021 and 2022. Ladies and gentlemen, Mr. Swaminathan. Our next speaker is Mr. Ramann. He is the chairperson of the Pension Fund Regulatory and Development Authority, PFRDA, since June 2025. And prior to this, he was the Deputy Comptroller and Auditor General of India. He is an officer of the Indian Audit and Accounts Service. He was the Chairman and Managing Director of Small Industries Development Bank of India, SEBI, from April 2021 to April 2024. And before joining SEBI, he was Managing Director and CEO of the National E-Governance Services, NESL. Prior to joining NESL, he was the Principal Accountant General, Audit in Jharkhand. Earlier, he worked with SEBI for 6 years, initially as Chief General Manager and later as Executive Director between 2011 and 2013. He also worked as First Secretary at the Indian High Commission, London, for auditing the accounts of various Indian embassies in Europe. Ladies and gentlemen, Mr. Ramann. Our next speaker is Mr. Kamlesh C. Varshney. He is the whole-time member, Securities and Exchange Board of India, SEBI, since September 2023. He handles various departments like Market Intermediaries Regulation and Supervision Department, Legal Affairs Department, LAD 1, Integrated Surveillance Department, Information Technology Department, Recovery and Refund Department, and Special Enforcement Cell. And prior to this assignment, he was the Joint Secretary, Tax Policy and Legislation in the Department of Revenue, Government of India. Ladies and gentlemen, Mr. Varshney. And moving forward, may I now request Mr. Damodaran to share a few words.
Good morning, ladies and gentlemen. It's good to see all of you back. Hope you had a restful night after day-long sessions yesterday. I know that it can be very tiring at this stage in life for most of you, and I speak for myself also, to sit on straight-back chairs and listen to serious speeches on serious subjects. It can be quite taxing, it can be quite tiring, so I hope you've managed to catch some rest between yesterday evening and this morning. And thank you for turning up in large numbers. The second day is often a challenge for people who organize programs like this, to see that we get enough people in the audience. But what we are serving today is fare of the kind that you will rarely see, because alongside me here, I have 4 persons holding very senior positions, leadership positions, pole positions in regulatory organizations. And I'm privileged today to formally welcome Mr. Ajay, Seth, Chairman of the Insurance Regulatory and Development Authority, Mr. Swaminathan, Deputy Governor and an SBI veteran, if I may call a young man that. Mr. Ramann, my old colleague, young old colleague. He's young, but we were colleagues quite some years ago in SEBI, and Kamlesh Varshney, who now handles some of the difficult, if I may say so, departments in SEBI and is trying to give it a human touch. 4 regulators on stage, and you might wonder what the 5th guy standing up here now is doing. Just trying to imagine the years gone by when I too used to be a regulator. And that is why I thought I will sit in this company. I have nothing more to share with you, so that I can also relive the experience of being a regulator in such august company. Just one announcement I made yesterday, I won't take up too much time, is that yesterday we formally launched, those of you who were not here yesterday, this is especially for you, we formally launched an initiative called the Directors Community. It's not for independents, it's not for non-executives, it's for all directors. The entire community of directors, and therefore we call it the Directors Community. The details you can get if you access the QR code which is in front of you. And I urge you to join this in large numbers, because I personally believe, and I've heard this from people in SEBI, that independent directors must articulate their thoughts in an organized manner, not everyone firing off from here and there, and be a kind of a body with which, even though it's not structured, with which we can engage as part of the consultative process. And therefore we started this initiative. It's a pan-India initiative. The interesting thing is there are no membership fees and all of that stuff. There are some benefits that you might gain, but some benefits that you too should bring to the table because of your experience. I thought I would mention for those of you who were not here yesterday but are here today, and pass that message around. Without further ado, let me turn it over to the speakers. You've come to hear them. I have a ringside seat. I will hear them from here. I will not impose myself on you with any long speech. That's not my objective of being here. The available time is theirs. As in the first session yesterday, there will be no questions and answers, because as you know, regulators ask questions. We don't ask them questions, right? Okay. We do sometimes, but you can't do it in fora like this. Let's utilize the available time to hear them. Thank you very much. And without further ado, may I request Mr. Ajay Seth to come.
There we go. Namaskara. A very good morning to all of you. If I can speak for all people present here, and certainly for myself, we are here for the high regard we have for Mr. Damodaran, and the kind of a leadership and in professional field, in financial world, and in the regulatory space he has created for everybody. It is a masterstroke on his part to get all 4 regulators on the dais and make them speak on regulatory overlaps and gaps. And he's on the dais so that all 4 behave themselves. So that's Mr. Damodaran. I'm truly delighted to participate in this summit. Over the years, this forum has evolved into more than just an annual conclave. It has become a crucible for ideas, a platform that brings together regulators, industry leaders, and governance practitioners, united by a common purpose to strengthen the moral and institutional compass of our financial system. In an era where markets evolve faster than the laws that govern them, and technology redraws the boundaries of engagement overnight, regulators today shoulder an ever-deepening responsibility. A responsibility that demands not only vigilance but imagination, for the foresight to anticipate risks, the agility to adapt frameworks, and the courage to uphold the public interest at all times. As regulators, we are often accused of doing both, too much and too little. Too much when the oversight feels heavy-handed, and too little when innovation on crisis expose an unguarded corner. As a developing country, we need to create ample space for innovation to thrive. We cannot afford to have a no-accident policy. We need to build resilience to deal with any accident or misadventure, but innovations must thrive. So the question of this session, do regulatory overlaps and gaps exist, may be complemented by another question, that is, do we have effective, efficient, and robust systems to deal with the overlaps and gaps? Let me take up the complementary question first. The interregulatory coordination aiming at dealing with those situations aims at 6 objectives, namely, manage the overlaps, second, find gaps, find bridges to fill the gaps, cross those gaps, ensure financial stability, promote financial sector development, fifth, lead efforts for financial literacy and financial inclusion, and the last one, undertake macroprudential supervision of the economy, including the functioning of large financial conglomerates. The current system is 4-tiered. At the apex level, there is a Financial Stability and Development Council chaired by Finance Minister. Thereafter, the next tier is a subcommittee of FSDC chaired by Governor RBI. Third tier is a specific inter-regulatory forums under the guidance of FSDC for early warning, monitoring financial conglomerates, fintech and financial inclusion, and the fourth tier is each of the financial sector regulators. In addition, there is a specific provision brought in about 15 years back, Section 45Y in the RBI Act, prescribing a joint mechanism to resolve a large set of potential overlaps. The experience shows that these systems are working fairly well. Of course, more needs to be done in terms of developing the financial sector. I'll list a few. 1, development of secondary market for corporate bonds in general. Second, supporting framework for issuance of long-term corporate bonds, especially in infrastructure sector. And investors from the insurance industry face a particular challenge on this particular aspect. Third, development of unlisted equity market. Again, investors or the insurance company insurers find it difficult to get into that space. Fourth, a basic minimum common framework for large financial conglomerates in corporate governance, assurance function, and cyber security. And fifth one, developing market to support instruments to help release and recycle entrepreneurial capital. The regulatory gaps may lead to vulnerabilities as well as non-level playing field for regulated entities or even for the financial sector. On the other hand, the overlaps may lead to compliance overload or differing risk assessments resulting in suboptimal regulations. And we deal with both sets of issues. The experience of the past 10 years show that both sets were dealt in prudent manner. I list a few of them in the recent years. 1, management of the financial sector during and after the COVID period, the way all regulators came together along with the government to deal with those situations, the volatility in that situation. Second, code of conduct for alternate investment funds brought out by SEBI and RBI's regulations for lending to entities having investment by AIFs in which regulated entities may have provided contributions. Third, participation of non-bank brokers on NDS-OM platform to facilitate retail transactions in government securities. Fourth, backstop facility for investment of mutual funds in corporate bonds during periods of market volatility. Fifth, valuation of AT1 bonds, not the regulators here. NFRA was the regulator which sorted out that issue and provided the way forward. Sixth, participation of domestic financial institutions in GIFT IFSC through branch mode. Of course, there are several areas where inter-regulatory coordination is a work in progress. Again, to list a few. First, cyber security and prevention of cyber frauds. Second, harmonization of KYC norms, extremely important from the consumer's perspective. Third, pension products, wherein Mr. Ramann and I and all of us, including the SEBI, we are working together that how do we take that piece forward. Fourth, sharing of distribution channels across regulated entities under different regulators. Fifth, framework of function-based regulations. And sixth, transparency and benchmarking of cost of procuring business and intermediation. The first three, namely cybersecurity, KYC norms, and pension products, are getting attention with participation of all concerned regulators in the government with three separate high-level committees. Let me look at a slightly broader picture presented before you. At times, the different paths adopted by regulators lead to challenges in communication from public's perspective. Today, banks, mutual funds, pension funds, and life insurers all provide savings management services. For banks, net interest margin is the metric of cost of intermediation. For mutual funds and pension funds, the cost is benchmarked to assets under management. For insurers, the cost is benchmarked to the premium. These differing matrices make it difficult for the public to make informed decisions about their savings and managing those savings. A related example is bank assurance. The largest private life insurer pays 4% of all premium generated through its parent bank as commission. The second and third largest insurer in the private sector pay more than 15% to their parent bank and other corporate agents, almost 4 times. The industry average is around 12%. All this information is not even known to policyholders. Prima facie, their interest has become subordinate to interest of regulated entities. As financial sector becomes digitalized and interconnected, regulations of one segment by a sector regulator may give rise to regulatory gaps and overlaps requiring a close inter-regulatory coordination. The prime example of emerging challenges of interlinked financial sector could be found in the efforts of public authorities in formulating coordinated strategies on strengthening cybersecurity in the financial sector and climate risk resilience. As regards increasing interlinking of different segments of financial sector, there have been many instances in the recent past, domestically and globally, where the functioning or disruption in one segment of the financial sector has resulted in financial stress and instability in other segments or even overall financial stability. Here, within the country, the ILFS default crisis in 2018 led to severe disruption in functioning of the corporate bond markets, requiring several liquidity support measures by the government, RBI, SEBI, in a coordinated strategy to strengthen the financial stability. The Financial Stability Assessment Report of 2025 by IMF and World Bank has acknowledged that Indian authorities have advanced cybersecurity risk oversight, especially for banks, but has recommended that extensive cybersecurity crisis simulations and stress tests for banks could be expended for cross-sectoral and market-wide events. It is encouraging to note that in the context of FSDC's work in the 29th meeting in June 2025, the Council had has considered strengthening the cyber resilience framework of the Indian financial sector through a financial sector-specific cyber security strategy. And currently the work is on, and we expect that early part of the next calendar year that the draft strategy should be with us. As regards climate risk resilience, all the regulators and the government should work together in developing a comprehensive and consistent framework to identify, assess, and monitor systemic climatic financial risk and adaptation measures. The latter is fairly important or are the centerpiece for our developed economy. The objective should be to ensure that effective management of climate-related risks and opportunities should promote long-term financial stability without compromising on the nation's development aspirations and priorities. Here, at the same time, regulations may have to move in tandem with and not being ahead of the policy. Another facet of inter-regulatory coordination is the joint regulation of financial products, like joint regulation of exchange-traded currency derivatives by RBI and SEBI, and joint understanding on regulation of electricity derivatives between Central Electricity Regulatory Commission and SEBI, leading to introduction of electricity futures in July 25. The joint regulation of currency derivatives ensures coordination on policy, risk management, eligibility criteria for exchanges, and market surveillance, particularly for products involving the Indian rupee. Coming to insurance sector in particular, a significant regulatory gap, at least from the insurance sector's perspective, is the voice of public at the stage of regulation making. And I'm just introduced, so Mrs. Raj Lakshmi here, who has been talking for years in that particular domain. While views of the insurance industry gets well articulated, we need to find ways to bring in expectations of policyholders, both current and potential, in a more structured and extensive manner. Another significant regulatory gap relates to health insurance and services. The health service providers are largely in unregulated space. The relationship between the health insurers and health service providers is through commercial contracts, which are in need of better structuring and a better equilibrium. Before closing, I would like to mention one more piece in the regulatory architecture that is a work in progress, and that is a National Financial Information Registry that can facilitate immensely in improving efficiency of credit products. Thank you very much for your patience.
Good, sir. Yeah, thank you. Good morning, everyone. The event host and the chief architect of the forum, Mr. Damodaran, Chairman IRDAI, Shri Ajay, Seth, Chairman PFRDA, Shri Ramann, the whole-time member SEBI, Mr. Kamlesh, Varshney, and other distinguished guests, colleagues, ladies and gentlemen, a very warm good morning to all of you. At the outset, of course, as Mr. Seth said, we are all here for the highest regard that we have for you, sir. Thank you for getting us here. We all have grown up listening to your speeches, and speaking in front of you is a privilege. And then through this masterstroke of getting four of us on this forum together, you have got a de facto IRF of the FSDC, which Mr. Seth referred to. So the Interregulatory Forum, de facto. I'm really pleased to be here today for the 10th edition of the Gatekeepers of Governance Summit. As conferences like these provide an opportunity, or these platforms are invaluable platforms, if I may say so, for the stakeholders to articulate and understand each other's perspectives. I thank the organizers for this wonderful opportunity. Our theme today is simple to ask but hard to answer. Regulatory gaps and overlaps, do they exist? I think the answer looks very familiar to all of us, but we will try to answer. Most organizations, as we all know, having spent 3-4 decades in public, we all know that most organizations often respond to governance questions by redrawing the organization charts, tweaking the reporting lines, and updating committee charters. This is what the normal response that we all do. These fixes do help, but only to a point. So the business models, technology, and vendor chains change faster than boxes on a slide. As firms expand, digitize, and outsource, and integrate, two patterns keep showing up. One is overlaps, two teams or two regulators asking for the same thing, and gaps, a new product, a partner, or a data set sitting outside or at the perimeter of any policy or regulation. If we keep editing diagrams without analyzing the root cause, we treat the symptoms and miss the cause. In my view, the reason is intent. When intent is strong and governance is lived in spirit, overlaps simplify and gaps close. When intent is weak, the reflex is to add more rules and procedures, multiplying work but losing sight of the real risk. The real question is how deeply good governance is internalized in everyday decisions and board oversight. So because we have a large number of people who are all part of the board process, so with what lens we should see is what I was trying to put. I thought I will put this into 5 practices that we all may adopt or which matters the most. Number 1, boards must own outcomes, not paperwork. Number 2, independence should be in substance. Number 3, look through the group, not just an entity. 4, protect and empower the control functions. And 5, governance gap analysis with real remediation. Let me briefly elaborate on each of these 5 aspects. Firstly, boards must own outcomes and not paperwork. A diverse and independent board keeps an organization on track by overseeing compliance, risk, culture, and ethics. Directors must exercise their duty of care and duty of loyalty, and they must own outcomes. Boards must set risk appetite and outcome goals and require independent assurance, risk compliance, and internal audit to test what matters and report findings, root causes, the owners, and the closure dates. Secondly, independence is not a label, it's the ability to challenge. It's a posture backed by time, information, and courage. Independent directors should be able to challenge strategy, controls, financials, and risk, and to question the assumptions behind the forecast. Our anonymous 2024 survey done by RBI, our anonymous survey 2024 amongst the boards of banks revealed that many boards prefer consensus, and a meaningful minority of directors hesitate to voice dissent. The chair's role, therefore, is to draw out quieter views and keep challengers safe. Thirdly, in large conglomerates, risk does not stop at the boundaries of individual entities. Boards should see the whole and not just the parts. 2 steps help. First, ring-fence critical entities so a local problem does not become a group crisis. Second, enforce strict related party policies. Such transactions can be legitimate, but they need transparency, fairness, and arm's length terms. Sound rationale and good documentation are evidence of thought and a tool for future learning, but not a bureaucratic burden. Fourthly, the 3 lines of defense must be real. Business lines own risk. The risk management and compliance provide challenge and guardrails. Internal audit tests the system independently. The heads of assurance functions, as you all know, the CRO, the CCO, and the head of internal audit must have access to the board and to any business line that can create material risk. They should have adequate budgets and full access to information. Decisions on their appointment and removal should rest with the board. Weak lines of defense are a board failure, not a staffing glitch. An anonymous supervisory survey again among the assurance head that we did last year found that while most reported strong board backing, but almost half said resources do not match their banks or institutions' size and complexity. It's essential to give assurance heads independence, stature, and adequate resources. Otherwise, assurance stays ornamental. Finally, markets move faster than rules and regulations. A periodical governance gap analysis helps organizations to see where their policies and frameworks stand against industry best practices, spotting weaknesses, strengthening compliance, and improving risk management. So for a system-wide perspective, we all know modern business is not tidy. A listed company can be a part of a conglomerate with banks, NBFCs, insurers, brokers, payment firms, tech subsidiaries, overseas arms, and associates. The regulatory map is equally rich. You have company law and MCA, securities regulation, and listing rules, sectoral regulators for banking, insurance, pension, competition law, insolvency, accounting and audit oversight, market conduct, data and cyber requirements, and multiple enforcement agencies. Add international obligations, exchanges, depositories, SROs, and state-level authorities, we have too many. In such a world, some overlap is inevitable. That is not a bug. Overlaps can also act as layers of safety net, ensuring that if one control misses an issue, another may catch it. The real problem may therefore arise from conflicting rules, duplicated compliance, and uncoordinated enforcement, which is avoidable. At the same time, new activities, new technologies, and new business models can fall between the cracks. So, we do agree both overlaps and gaps exist. The task for regulators is to work together, minimizing harmful overlaps and closing material gaps without choking innovation. In that spirit, let me offer 3 principles, supplementing what Mr. Seth already said, 3 principles, aspirational maybe in parts, for optimizing overlaps and gaps. Firstly, regulators must balance entity and activity-based regulation. Regulate the activity wherever it happens and keep stronger rules for entities that hold public trust. If an app offers investment advice, the advisory guardrails should apply, even if the provider is not a traditional intermediary. If 2 activities create the same risk, they should face the same rules, regardless of the label of the provider. The second principle is proportionality. Regulators should scale requirements to risk and complexity. A small, simple firm should not bear the same burden as a large, interconnected group. Systemically, important players should meet higher capital, liquidity, control, and disclosure standards. Proportionality keeps oversight credible and optimal. The third is to strive towards outcome-based regulation calibrated to market maturity. Where feasible, draft and apply rules to protect outcomes, fair customer treatment, resilience, true and fair financials, rather than looking or locking the processes or technologies. For instance, whether onboarding is on paper or biometric, the test is the same. Was the customer identified correctly and was consent captured properly? However, calibration matters. Outcomes-based rules work best when supervision and enforcement are strong and markets are mature. So in conclusion, addressing regulatory gaps and overlaps is a journey of continuous improvement that demands constant reflection, adaptation, and courage to challenge the status quo. I have covered my speech broadly into 2 parts. One is that as to what the boards can do, and second is what regulators could do. The point that I'm trying to make is that the gaps and overlaps do exist, we acknowledge, but when the intent is strong, the gaps bridge, overlaps simplify, and governance transcends mere compliance to become our shared conscience. Thank you. Jai Hind.
A very good morning to all of you. I must repeat, but it's always nice to repeat good things. So we are here because we have worked with you, learned under you, and thank you so much for having me here. Very good morning to my fellow speakers, ladies and gentlemen. So I just wanted to share a few thoughts that have over time come into my mind. I'm sure all of you are equally in your own experiences. You've already figured out where are the gaps and the cracks and where is the overlap. But I've had the fortune of having worked as a regulator at SEBI, and much of the time I was in surveillance, and then I handled what is known as the Market Regulation Department, where we wrote some seminal regulations, including the SECC as it stands today. And therefore, one has seen a fair amount that transpired during those 6.5 years that I was there. In fact, what Mr. Seth was talking about, the genesis of the FSDC itself happened at that point of time when there was a regulatory overlap, if I may say, or a regulatory sort of clash, if one were to go to that extreme, between the products that were overseen by SEBI and the product overseen by the insurance regulator. And this was actually something that finally led to the creation of the FSDC. So, we are all very clear that, if there are regulatory overlaps, most certainly, and they play out in their own unique ways in our regulatory architecture in the country. I further had the wonderful experience of setting up the information utility where NESL, as an information utility, was the regulated entity of the IDBI. So I was on the other side of the fence, and I had the fortune of having as a regulator my ex-boss and friend, Dr. Sahu. But that, of course, did not give me any additional advantages at all. And we went through a phase where we built a particular facility called the Information Utility, which holds all of India's financial debt. Today it's about 240 lakh crores, which is held there as evidence, digitally signed by both parties. And this led the company called NESL to innovate, and today we have got innovations that are there in the market, which are known by e-bank guarantee, digital document execution, and those innovations happened completely outside of regulation. In fact, somewhere I feel the way we went about innovating and creating those products because we felt the banks were going to benefit from it, but we had no locus, no regulatory support in doing so, and that's when further regulation got written. And of course, then I came into SIDBI. We did not know whether we were fully regulated by RBI or partly by RBI, partly by government, and we had an act in which we could write regulations for ourselves. So, it was, as an All India financial institution, one of those, creatures which have been created for a specific purpose to solve for a big problem that has been observed in the country, and therefore Parliament, in its wisdom, passes the act, provides certain rules and regulations, and powers to make regulations, which I think SEBI and SIDBI and NABARD still enjoy. So it has been a good journey, and therefore many thoughts that go along. And I wrote it down on a piece of paper, and I sort of thought I'd share with you what I think are gaps and overlaps, and let me just share that with you. Gaps emerge when innovation outpaces regulation. Overlaps arise when regulators act prudently to ensure no risk goes unregulated. So this is really where I understand that when we have an industry which is full of creating products, is serving the customer's need, is trying to take forward, in the spirit of the Act, the different services that are needed. But regulation can never a priori account for all those services and all those products which may be needed. And that is why, even in the theory of regulation, we have the concept of a regulatory space which is co-owned by the regulator, by the customer, and by a series of intermediaries. And that is why the whole concept of regulation has today become a subject matter of deep study and large and widespread thought, where how is it that we can make it easier and better for all the actors concerned to be speaking to each other on a continuous basis, to be able to swiftly bring in changes, regulatory changes, and to be able to allow for regulators to give the freedom to the intermediaries and the market players to create new products. And therefore, things like sandboxes, which now have become very popular, and the RBI has done a great job in making that happen. At SEBI, I was one of the beneficiaries of putting a product called GST Sahai into the sandbox, because we didn't know what that really meant. It was meant to be a working capital product, and it is entirely based on the GST returns of a small business, and therefore you give working capital based on the scores that emerge by running algorithms on the GST and the current account. So, this is really where new products are getting created by persons who, or entities which are not giving working capital. Working capital is given by banks. SEBI was not meant to be giving working capital, but there was a felt need that we need to have a working capital product. So this is where I think we've seen a lot of innovation, a lot of positive movements where the country has got, let me say it's got completely into the whole regulatory framework and is allowing for a very, very vibrant and productive interaction. Another thought which comes up, and this is really on chit funds and collective investment schemes. Now, is this a gap? Now, you could argue that yes, it's a gap, but it's a gap because it's not in the formal financial sector. Now, when we people in this room talk financial sector, we think it is the financial sector regulators, and therefore we don't consider the fact that chit funds are regulated under respective state acts. But we tend to compare that why is a chit fund risky and a bank account is not risky and an investment in a stock is not risky. A chit fund is deemed risky. And we've had enough schemes which look like chit funds, probably are not chit funds, were never regulated. We have the Sharda, the Rose Valley. These are names that, sort of were household names at one point of time. And all were created to extract money from innocent customers. And at one point of time, what was seen as a useful product to those customers ended up becoming a measure and a way of decamping with money. And this is really where we need to ask ourselves that why is it that chit funds do not receive the level of more detailed regulation and the guardrails that are probably needed, which we have seen in what is more known as the formal financial sector. So there is an interesting aside on this, and one of the startups which I happened to come across during my stint at SEBI, these guys were actually creating a risk profiling of small customers where they were encouraging them to run chit funds on a digital platform. So it once again tells you that the way we are sort of moving ahead, and this is something which nobody has really gone ahead and looked at it from a regulatory point of view. It's one of those innovations that keep happening in our market where because you have run through several rounds of a chit fund, and it really runs with a group of 10 people coming in and closing a chit fund anywhere between 1 week to 6 months or 10 months down the road. And therefore, because you have gone through so many cycles, you know that somebody is a player with this kind of behavior and somebody else is probably more risky, and therefore a risk profiling happens. And this is the kind of results that can really help even the traditional lenders to understand, okay, we have these risk profiles, this is useful in the way we can do our credit underwriting. So we have a situation where so-called under-regulated products, and when they are infused with a good proportion of technology, it ends up becoming something which is even more useful for the banks, which in their traditional methods could not have probably thought of or have had the access of the data. So then it really takes me to the whole concept of fintech lending, which I saw while we were sort of operating both with the small businesses as in SEBI, and also through the SEBI fund of funds, we were putting in money into AIFs, which were then funding a lot of these fintechs. And the single biggest issue that came about was, can a fintech lend? I mean, that was really the big question, which finally RBI sort of brought in several guidelines and rules and made it much clearer to all of us. But this was the sort of earlier days in sort of 19, 20, 21, in that phase. They were probably all under a Money Lenders Act. And that is the other great part, that we have a plethora of acts. Some are central, some are state, some are, on the concurrent list. And therefore, we have a situation where it's difficult to say something is entirely not regulated, and therefore it is weakly regulated. Now, that weakly regulated served everyone's purpose very well, till we found that customers and clients were sort of losing money or getting fooled with schemes of fraud. But when it comes to fintech lending, you have a complete audit trail. And the question therefore becomes, can the fintechs bring in that power of fintech-based lending into the traditional well-regulated entities? And I think today when we speak, looking back at the last 4 to 5 years, we probably would unanimously agree that all banks are probably fintechs. In their own way, we have seen the digitization sweep through all the banks. I mean, the capital market entities, I think, were already fintechs many years ago. So it's very interesting to find how innovation, with the benefit of tech, has gone ahead and led to a possible gap, but then, as we see, it does get covered in a reasonably short period of time. We also are quite aware that there are silos, and these silos, so-called, happen between the regulatory bodies. And I think the only reason why these silos happen is because there is a super specialization in each particular area. I mean, the capital markets in 2010-11, I remember we were plagued with algos, and we did not know what to do. We actually started, put out a circular saying that if you put so many orders per second, and if it exceeds a particular number, you'll get penalized. I mean, that was the only reaction as a regulator that we thought was prudent, because we wanted to reduce the number of algos being used for trading. Today, I think the entire market is trading only through algos. Individuals are running algos, which are thankfully well tested. So there is an entire arena of regulation which deals with algos and how they are to be tested, how they are supposed to come onto an exchange platform on a test bed to be then properly vetted, and then it can come forward and then you are allowed to use it. So we've seen the innovations, we've seen regulatory reactions to innovations, and then we've seen a more rational, long-term, long-serving policy which then sets in. And that is really how I think we are going to continue to see this, because it's impossible to stop and check the need for people to provide services and products which are useful to the larger world. In the pension space itself, I mean, it's a space which is, not that sort of vibrant as capital market, but we have a concept of a gap. Now, this is really a question which came to my mind, that is coverage also a gap? And my answer would be that if I were to look at regulators from a development lens, and some of us as regulators have the word development very clearly written in our names. I think the fact that we have failed to cover the large swathes of people in this country with a particular product is certainly a gap, and it is a regulatory gap, because there is a mandate for you as a regulator to be able to bring forth a set of products which probably we have not been able to do, especially I'm speaking as in the pension sector. I mean, we've got a wonderful set of products for the government employees. In fact, if some of you would have been sort of following it in the newspapers, we have a unified pension scheme which has now come on the heels of the national pension scheme for government employees. And it actually brings about a brilliant a median between the old pension scheme and the national and the national pension scheme, where it allows for pension payouts to happen much on the lines of an inflation-indexed pension payout, which was known as the old pension scheme. And all this has happened within the existing set of regulations, which was actually backed by some serious modeling and calculations and projections, which was done between PFRDA and the Ministry of Finance. And somewhere the whole concept of pension payouts using UPS, which of course has a government guarantee at the end of it, but it is one more great innovation within the pension space. And therefore, the real challenge that we have put to ourselves at PFRDA is, how do we make sure that we have a UPS equivalent for the private sector? I mean, why would not everybody in this country want some kind of a market-linked guarantee which is built into their pension, which is at least giving them an inflation-indexed pension stream for a period of time, need not be all the way to life. So this is something which we've already thrown up, and therefore the need to bring innovations into the pension sector is something which is now regulation-led or regulator-led. And sometimes it's very good that the regulator also comes forward and sort of creates or engenders the innovations that are needed in that particular sector. So it is really from the lens that we see it, we know what is a gap or what is an overlap. And sometimes the overlaps are really, and as the earlier speaker, Mr. Seth, talked about the currency derivatives. Now the currency derivatives were created so that there would be a flourishing market for interest rate futures and for the currency derivatives. Both of these markets were created about the same time, and both have this interaction between SEBI and RBI. And somehow, has there been enough participation in that? Has that market been as vibrant as, say, the equity F&O market? That's really when we need to look at these innovations and see what further is needed. I remember another very important innovation that was brought out was the Securities lending and borrowing mechanism. Somehow, I'm not sure where exactly it is, but it never really took off. It was meant to be a sort of, replacement or a digitization of the Badla system, but it never really took off. So it's very helpful for the regulator also to sort of go back and see what were the innovations and where are they standing as of now. So regulatory gaps directly impact financial consumers. And when oversight is blurred or delayed, we have the consequences of mis-selling, fraud, and a host of grievances that get thrown up in the system. We have, in fact, very serious problems of the lack of proper processes within a particular regulatory system, leading to unintended consequences where there is an entire business that has got set up under the regulations of the EPFO, where because people are unable to track their numbers and get their withdrawals from the system, we have great business practices that have come up, and there are a bunch of very innovative companies that are providing this help to the customers and making a sort of, a good service out of it, purely because there is a lack of process and a lack of due diligence in that entire system which deals with the Provident Fund. And finally, let me just sort of talk about how AI and the kind of changes that are happening. In fact, it's wonderful to see RBI coming out with what's known as a free AI framework, which is really looking at how cross-sectoral regulation can happen when we are all in a phase where AI is sort of on top of us. And that's the kind of inter-regulatory coordination and cooperation that is really needed, because it's only then when the silos sort of dissolve. We can also have a understanding of where we are vis-a-vis the IFSCA, which is the only regulator in India which is cutting across all the regulatory spaces. It's a single regulator for a particular jurisdiction, which is the IFSCA, but it actually does the job of all the regulators in a single place. So, that's another very good experiment that we can see how gaps and overlaps can get reduced within the regulators within the domestic space. So I think I've taken up a lot of time. I will just put a rest to what I have to say, but thank you so much for hearing me patiently. Thank you.
Namaskar and good morning, everyone. It's really a privilege to be in the company of all such stalwart of financial regulation, Seth sir, and also Swaminathan sir, Ramann sir, and above all, I think we have a lot of alumni from SEBI here, those who have worked in SEBI, with Damodaran sir as the chairman. I think the kind of legacy he has left behind in SEBI, we should call him Bhishma Pitama of SEBI. People will come and go in SEBI, nobody is permanent, but the thought process that he has left behind is going to remain forever. And it's good to see that even after his retirement, he is so actively involved and keeping all of us engaged and bringing out new topic like this topic, regulatory overlaps and gaps. So first of all my 4 previous speakers have spoken a lot and have covered most of the spectrum that you wish to cover. So if I am going to speak anything, I'm sure there will be a regulatory overlap with what they have spoken. So please excuse me for that. I will try to see that there is no gap left behind, only 7.58 minutes are left. So I will try to cover in that. Okay. So, FSDC has been spoken about. That's a very good council for reducing these regulatory overlaps and addressing the gaps. And we have seen how successful it has been. I think one example that I will like to give is a classic example of how government is taking initiative to address these concerns. In fact, what Seth sir has said in the beginning is the main takeaway from this conference is there would be regulatory overlap, there will be regulatory gap, but how do we address them effectively? That is the main point. And the classic example of how government has addressed regulatory overlaps in KYC through CKYC KR is a classic example. We know in security market we have KRAs. They have been very successful. You do KYC with one security market intermediaries and it is transported to another one. You don't have to do KYC again. But is that enough? No, because one citizen of India does not deal in security market alone. He also goes to a bank. He also goes to insurance service provider. He also goes to provident fund provider, pension service provider. So we have to address all these. So this noble concept of CKYC KR, which is taking shape, is that you do KYC with any financial service provider once, and then it is transported to everywhere. So this is a classical example that yes, there are regulatory overlaps because each regulator wants you to do KYC, but can we effectively address them? Now, taking from here, can we think for the future what we already have done successfully in security market, consolidated account statement. We all know as an individual how beneficial that statement is. It puts all our security market holding at one place. It helps us, our legal heirs, our nominee, to inherit those properties without any hassles. They don't have to search, after a person passes away, which bank he has account. I mean, legal heirs don't even know. But CAS is one consolidated statement in security market which gives all asset at one place. Can we have this scope of this be extended to include all financial assets? I think that is something which will be another example, successful example like CKY, CKI. Now coming to specifically what we have, we have spoken about a lot about regulatory overlaps. In the context of SEBI, normally regulatory overlap people often complain is with respect to Companies Act. Like we have our provision in LODR, companies have to follow certain things, while Companies Act also mandates. And it is often a feedback that there are regulatory overlap. LODR is more restrictive, requires more compliance. Just to illustrate, let's see the board composition. While Company Act says 50% should be independent director, and 1/3 should be independent director. But LODR says that if your chairman is an executive chairman, then 50% should be independent director. So how do we address this regulatory overlap is that if you comply with LODR, you are already in compliance with Companies Act, because Companies Act says minimum, so you can have more. So same provision is there when we talk about composition of audit committee and composition of nomination and remuneration committee, because Companies Act says that 50% independent director, but LODR says 2/3 independent director. So if you have to have 2/3 because you have to comply with the LODR, you are already complying with Companies Act of 50%. The question is why they should be different numbers. Ideally, I think this is for the reason that Companies Act is for all type of companies, whether they are listed or unlisted. But in case of LODR, it is listed entities, and because it is a listed entity, they are public shareholders, so their interests have to be protected. So therefore, you will find these requirements be slightly different from the requirement of Companies Act. But it is not that that LODR requirements is in conflict with Companies Act requirement. Because when you comply with LODR requirement, you comply with Companies Act requirement as well. But the basic thing is, what is the purpose of having these independent directors? I think this point was also touched upon by Swaminathan sir, that independent directors should be able to challenge. So that is what, is that happening in the board meeting? Is that happening in the audit committee meeting? So these are the things we need to probably address. At the same time, there are feedback from independent directors that we are also not sure what is our functions, what is our responsibility. And we often find that if there is a violation by the company, we are also issued summons, we are also issued show cause notices. So that is one area also we have to address, because we want good people to come as an independent director. And if we have if this is not clear that what responsibility they have to fulfill, that you will find good people not willing to come forward as independent director, and we will not have quality oversight in these board meetings. So therefore, as a regulator, it is our duty to provide clarity in the role of independent director, and our expectation from them is that in substance, you perform the role of independent director. So these are the challenges that we have at present, and I'm sure that with the cooperation of everyone, we will surely address these challenges. Similarly, in RPT transactions, there is a lot of difference between Companies Act and LODR. What is RPT? Once again, Companies Act definition is narrower, and LODR is wider. Same is about material RPT. Same is about approval in audit committee, while LODR says that only independent director should approve RPT. Once again, the reason is simple, that Companies Act is dealing with both listed and unlisted entities, and LODR is dealing with listed entities. So it is important that we ensure that, because RPT is one type of transactions where transparency is required, to give assurance to minority shareholder, public shareholder, that things are happening in the company in a professional manner. I think most of us are, probably all of us are civil servants here. So when we join civil servant, first thing which is taught to us is, you should not only be fair, but also appear to be fair. So it is that appearance, transparency, which is extremely important, that the message is given to the public shareholder, minority shareholders, that even though you don't have control over the company, your interests are taken care of. So these provisions that we have in LODR may appear to be regulatory overlap with Companies Act, but they are there to serve a particular purpose. But let us move from regulatory overlap. Can we, through administrative measures, address these overlaps? Now that is again coming down to the same point which was first raised by Dr. Seth, that how effectively we address these regulatory overlap. So idea is to provide ease of compliance to company. Maybe there are different requirement under the Companies Act, different requirement under SEBI, but can we have a ease of compliance? So we are taking steps in that direction. Like we have a common, right now companies were required to file, suppose a company is listed with NSE as well as BSE. So it is required to file duplicate reports with NSE and BSE. We have addressed that concern, and to a large extent, they now have to file only at one place. Some more work is required to be done here, but within a few months, you will find that it will be fully achieved, and they will file their report only at one place. So this is one step forward. Can we take it further and have some kind of a concept like annual information memorandum? That is just a thought process. Nothing has happened in this direction. But the thought process is that if we can have a company filing annual information memorandum, which not only contains LODR information, but also Companies Act requirement. Of course, we have to work with the ministry in this direction. But if we can have that kind of an annual information memorandum, not only it will be an ease of doing compliance for all these listed companies, that they have to just file all information at one place. They don't have to do it again and again. It will serve more than one purpose. First of all, there is a currently information arbitrage between what we have in primary market and secondary market. And I will explain how that will be addressed. Because one, you have information, annual information memorandum, which not only has LODR information, but ICDI information as well, which you file when you file prospectus. Now, if that information is also included in annual information memorandum, your future public issues will become very convenient. Because then you don't have to file that prospectus again and again. Everything is already filed in that AIM. Probably only small information like what is the object of issue and all that you may have to file. So this is one thing which is currently only at a conceptual thought stage, that can we, through administrative measures, address these regulatory overlaps and provide ease of convenience to the companies. Gaps, talking about gaps, a lot have been spoken. Gap is essential because, as Ramann says, that when innovation outplays regulation, there would be regulatory gap, and that is what has happened. Sets are addressed about cyber security, climate risk, all those issues which are very much relevant, and where a coordinated effort among all regulators are already being taken to address these gaps. Another issue probably which could demand attention of all regulators in future is crypto. this is also one area probably in future we all regulators have to come together and address these regulatory gaps. And then another area which probably could be about regulatory gap is that while we have boards and board committee in listed entities, do we have a mechanism to review their performance? Similarly, like what was said yesterday, that do we have a mechanism to review the performance of regulators? So good idea, and probably yes, we should have a mechanism to review the performance of regulators as well, and we should have a mechanism to review the performance of these boards in the company. Because ultimately, we all are working in a fiduciary capacity, and we should be answerable to whatever actions we are taking. My last point is on something which is troubling everyone right now, and I am not saying it's a regulatory gap, but it is something food for the thought. That is whether the valuation that is being carried out at this point of time is correct or not. We have seen a lot of IPOs are coming where retail investors are challenging the valuation. SEBI has taken a step which I think is the right step. We have moved away from control of a capital issue. There is absolutely no justification to go back to that kind of system. Valuation should be determined by anchor investor, which is happening right now. This is the correct methodology. Now, we think that when anchor investors are doing valuation, SEBI should keep itself away, which it is doing, and which probably is the right thing, but without compromising on this position, how do we ensure that valuation by anchor investments are also taking place properly, effectively, efficiently? I think that is something we need to talk about. That is one point of valuation. Another point of valuation where SEBI is involved is valuation during corporate arrangements. You must have seen few interim orders. There are other cases that we have seen where corporate arrangements are taking place and promoter shareholder probably get valuation at an inflated price to get a better swap allocation, which is to the detrimental of minority shareholders. And lot of complaints we are receiving from these minority shareholders that their interests have been compromised. So this is one area probably which is something which I feel not in the IPO area. IPO area is not a regulatory gap, but we have to see how we can further put guardrails. But in corporate arrangements, valuation is one area. Can we provide guidelines for valuations? The way there are guidelines in transfer pricing. So maybe this is one thing probably we may have to work with another regulator, IDBI. So this is another regulatory gap in my view probably we may have to work for in future. So this was just my idea on this topic. Thank you very much for your attention. Jai Hind.
So thank you, Mr. Seth, Mr. Swaminathan, Mr. Ramann, and Mr. Varshney for sharing your insights with us. May I now request Mr. Damodaran to please present a memento to each panelist. On behalf of each panelist, Excellence Enablers is proud to have sponsored education for one girl child for 1 full year through the NGO Nanni Kali, a Mahindra initiative. Well, it's a collaborative initiative between KC Mahindra Education Trust and the Nandi Foundation, dedicated to advancing the education of underprivileged girls in India. The project offers academic support, life skilling training, and essential resources to girls from low-income families, enabling them to complete their schooling and in equipping them with skills, including financial literacy and digital proficiency. Thank you, Mr. Damodaran, for doing the honors. Request all of you to kindly come closer for a group picture.